Welcome to the Open Treasury Podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where Treasury professionals learn and share the information that matters most.
Hello and a warm welcome to the Open Treasury Podcast from CTMfile. I am Pushpendra Mehta, Executive Writer for CTMfile. My guest for today is Craig Jeffery, Managing Partner at Strategic Treasurer. Welcome back to the Open Treasury Podcast, Craig.
Thank you, Push. I enjoy talking about this series of articles that you're writing on, so appreciate you having me on.
So for the benefit of our CTMfile audience, we will begin our conversation by discussing the third article in a series on leading practices in corporate treasury published on CTMfile. This article is on cash concentration. Craig, there are some themes that stand out in the article, and while these may vary or differ depending upon the location, size, and complexity of a business's operations, what would be your key recommendations on how organizations can design or adopt a modern cash concentration account structure to optimize cash management?
The concept of moving to a modern cash concentration structure is probably well known to most of our listeners. Typically, this happens when organizations, depending on the types of complexity they have, but when they move to They're north of 100 million. They're in a lot of countries, or they're 300 million USD equivalent turnover, 250 million pound sterling revenue. Those are times when organizations have multiple accounts, and they need to put the structure in place that allows them to mobilize the funds cleanly and efficiently. And so some of these concentration structures, allow you to move all the funds to a header account or to a concentration account, keeping the detailed level of transactions out in collection of receivable accounts or payable accounts, and keeping that all mobilized centrally for quick and accurate decisions, for good forecasting, and for the ability to spot any type of anomalous or attempted fraud behavior. So this is, putting these type of structures in place is foundational. I think for the most part it's well understood. It's not always well accomplished, especially as organizations cross different thresholds. They get more complex, they expand in areas. There's not as much efficiency to be gained when you first get a little more complex, but you can quickly outstrip what you're trying to do if you don't put these kind of structures in place. That's a core starting point.
May I seek your opinion on another aspect of this article? I know that you believe that every single account represents a point of exposure. Bearing this in mind, why is an automated cash concentration system or structure considered a prudent security measure?
Yeah, every bank account is a point of exposure. It's a point of cost. It's a point of efficiency or inefficiency. And so part of this idea is that, automated cash concentration system means that you're not relying on manual processes where someone can be sick or something may not happen. This means that your funds are automatically being mobilized. It's following your existing pattern and structure. It also allows you to put controls on the different types of accounts. Your banks offer numerous services that help with this control of mind, and using those services obviously makes sense, but it's easier to apply those when you have a modern structure and you take into account what is being done, what are the purposes of these accounts. And so there's other aspects of what do we mean by automated cash concentration structure for this, security purposes. This idea of we can see it is one key aspect. We can control it with services by the banks is a second. A third is now we've set up a process where we can, in a company, run different services, features, reconciliations, etc., to more rapidly detect any problem or anything anomalous, whether it's an attempted attack, whether it's an issue, or whether it's just an error. Those are some of the key reasons for looking at accounts as core points of exposure, but control and opportunity.
Moving forward, I would like to discuss an important facet of the fourth article in this series, which is on liquidity structure. We know that inefficient liquidity structures can keep corporate treasurers from achieving optimal liquidity management, both domestically and across currencies and borders. How, in your opinion, can physical pooling and notional pooling help in establishing an effective liquidity structure?
Moving beyond the description and dialogue that we just had about a concentration account structure, how do you concentrate funds? There can be a ZBA, same bank, same currency, that zero balances structure moves everything to a single account where you have access to it. Well, there might be some other aspects. It might be with multiple entities. It might be multiple currencies. And whether it's physically moving, which is oftentimes referred to as ZBA structure, where you might have funds at 10 banks. You set up a ZBA structure, all the funds move back to a single bank. That gives you the access to all of your cash globally. All your cash globally in every time zone as funds move around. It's the, I don't want to call it the holy grail of cash mobilization, but there's an aspect to it that it is. Notional pooling, stops with we don't have to actually move the money to your pooling bank, to your account at your pooling bank. It might move to their accounts at correspondent banks all over the globe. And so instead of having funds in 8 currencies that you can't all roll up, and notional pooling gives you credit for the euro or USD equivalent sum, allowing you to use money in its most efficient way, no matter what the currency is. So it also takes some of the costs out of your day-to-day volatility of liquidity. So these are great tools. They tend to come into play as organizations get a little bit larger, and the cost of these pooling structures now can be more than compensated for by the efficiencies gained, efficiencies of currency exchange, transfers, the use and cost of funds. So these roll into play as organizations get a little bit bigger.
The last question of the day that needs your valued perspective is on another type of pooling arrangement, which is insurance short-term investment pooling, also referred to as STIP. How does establishment of a STIP structure benefit or aid an insurance company treasury group?
I know this is common in the U.S. I'm not sure how many countries this is common, with all the different banking arrangements. But where this helps, short-term investment pool allows these treasury-intensive organizations with massive investments. They usually have lots of portfolios that relate to certain types of liabilities. Could be property casualty liabilities. It could be life insurance or some other set of liabilities, and they're broken out. They match their liabilities with their assets. And they usually do that on a portfolio basis. And so each of these portfolios or sections that they've broken out their liabilities with their assets, their short-term assets, they have to keep a certain amount current and liquid. Well, you repeat this 3, 4, 5, 15, 20, 30 times, then the organization as a whole maintains an excessive amount of short-term liquidity. And they have to keep it very, very short to meet potential needs that may emerge quickly. By using some of the regulations in these pooling structures, they can keep this all together in one place. Any one individual pool participant can get out all the liquidity on any given day, but as a mass, as a mutual activity, that pool can put money out further, hopefully riding the yield curve to some decent extent, without all of the transactions and all of the negative implications of doing all of this short-term investment activity for 15 different portfolios, for example.
That was a rather informative analysis, Craig. A big thank you to you, Craig, and to our CTM audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.